Bhatia is our market master of the day. He's managing director and head of equity India at Macquarie Capital. He's joining us now. So I think great to have you with us here. Good morning. Thanks very much for your time. You know, before I get to the market and how things are set up, I just wanted to address the calls which have come through from Macquarie this morning on Zomato and Swiggy as well. It's a big day because Swiggy, of course, makes it to the market, and you know the analyst has painted a pretty tough picture in terms of what both should actually trade at. So just wanted your thoughts, Sandeep, if you want to sort of weigh in. They're talking about unit economics being unfavorable, too high growth rate assumptions for the next 10 years, both on the food delivery and quick commerce side. Your thoughts, Zomato and then, of course, Swiggy now.
So first, congratulations to Swiggy, its management, for the listing. I think what we are trying to say here in terms of both Swiggy and Zomato is that quick commerce is a business which is in many ways unique to India. Given India's unit cost structure, low labor costs, and the ability of these businesses with their distribution structure, with their algorithms to map and manage to deliver almost in less than 20 minutes or even lesser items, from high value items to like iPhones and even low value items like daily consumption grocery items. It is definitely cutting edge business for both these companies. What is important from an investor and a shareholder point of view is what is being built into valuations. And our view has been that valuations, especially in some of the new businesses and IPOs which are coming through and getting listed, are very challenging and demanding. And that's why we think that while Swiggy and Zomato have an interesting business which is getting built up and developed, the challenge on unit economics, on cash flow generation, which are the real things which matter over long periods of time, will need to be monitored and will need to be measured. In our view, therefore, we are very cautious on both these names. On Zomato, we have been cautious. On Swiggy, now that we have numbers, we have comparison, and we'll soon have a listing price, we will definitely see prices and listing gains look very difficult right now.
Right. You know, what was also very interesting was your analyst's assumption of discount to valuations versus Zomato for Swiggy, and that actually is a lot lower than what the current prices of these stocks, the issue price for Swiggy and the traded price for Zomato, suggests as well. But while you did say that, you know, the current lot of IPOs are coming at top dollar valuations, which may not create a fair amount of wealth for investors, or they are pricing in a lot more than what can be delivered, it may actually do well for one of your other calls. And I'm talking about the NTPC Green IPO. And this morning, your analysts have initiated coverage on NTPC, a buy rating, target price of 475 odd rupees per share, benefiting from both energy security and energy transition themes. How much of the NTPC Green IPO valuations will weigh in on you know, your call on NTPC itself?
So I think you are pointing to the more obvious thing, which is the market is realigning itself. We went through a teenage infatuation phase in the market where everything new, bright and shiny is what we like. And this is what has happened with some of the IPOs. But the real cash generation ability and the real ability to deliver and execute on the ground is with some of the old generation sectors. And I think with the power demand, which NTPC is part of, whether it's green energy or thermal, and even on the power finance side, we have initiated on PFC and REC. So all these businesses are tried, tested, cash generating business where the underlying regulatory structures, the cash flow and the investments are all can be mapped out, and there's definitely much more certainty in terms of cash flows. So while they may not be something which is new gen, there is a lot of value, especially at the current valuations in all these names, which is why we have initiated on the entire power finance sector and the power sector with significant buys. So that's where we are coming from. I think the market itself is transitioning now as we speak. I think investors, both domestic and foreign, are recalibrating their investment portfolio strategies. And some of the, new IPOs which have come through, like the Hyundai, which also, delivered its results yesterday, all of them clearly are coming off and trading below the listing and IPO prices.
Hi, Sandeep. Good morning and good to see you in. Nigel on this side. Let's talk about the market on the whole. We've come off close to 9% from the peak. And also the problem has been earnings. For the past quarter, it's been one of the most disappointing quarterly earnings that we have seen. How much of it is in the price? Have you all scaled down your EPS estimates? If yes, by how much?
So I think the post-COVID period is well and behind us, and now it's more normal. I think there's clearly more downside to this market, maybe another 10% easily. It's not only just earnings that are disappointing. Our valuations are definitely very high. And, you cannot always be a cheerleader to the markets, waving pom-poms and dancing just because the market's going up. So we have been very cautious on the markets for some time now, and we will continue to be that. Earnings downgrades are coming across the board. They would be in double-digit terms, the cuts. I think the real challenge is what happens to fund flows over a period of time. While India has benefited both from domestic and domestic flows a lot, and foreigners have been selling, the view has been that India and China are the only two markets, and China will continue to disappoint, so India will continue to benefit. I think going forward in 2025, the real big gorilla on the horizon is the U.S. market. And the U.S. market will see both in terms of its economic activity and in terms of its political activity, significant investor interest. And therefore, to some extent, if we have a strong dollar going forward, all emerging markets, including India, will definitely be hit. So I definitely see correction in the market of up to 10% over the next 3 to 6 months.
All right, 10% correction over the next 3 to 6 months. That's a headline coming in, along with a 10% correction that we've already seen. Sandeep, going back to your point on, the markets going back to traditional cash-generating businesses, so to say, as against just the new age ones which we were infatuated by, in your words. There are a couple of cases in the consumer space where the incumbents are threatened by some sort of disruption. Case in point, the paints business, where, a new competitor, weak consumer sentiment, has, perhaps scared the current leader in terms of the numbers that they've reported. And the second part is the consumer space itself. We've seen Britannia fall about 10% over the last 2 trading sessions. Their volume, forecast is a little wobbly right now. A lot of people are talking about the underlying shift coming in from shift in consumer sentiment, urban consumption itself, where they're looking for healthier or no sugar options.
Yes, and so the question is, yes, there is consumption weakness and competition coming up in these players.
Do you still back the incumbents?
Well, I think the sectors that we would like... No, I think it's part of the same strategy that I've outlined, that investors need to rotate to some of the more certain cash flow businesses. I think one thing which people have ignored for some time is the entire private bank sector and PSU bank sector. I think both the banks are on a solid wicket. Despite some of the slow growth and inflation numbers that we see, I think the underlying macroeconomic structure, creditworthiness of corporates, creditworthiness of individual borrowers is still very, very decent. The system is rock solid in terms of capitalizations. Earnings growth will be in the region of 12 to 14%. So I think the bank sector will definitely benefit, and the other sector that could benefit if U.S. growth surprises, it could be the IT sector. Valuations in the IT sector are also not very demanding. So I think both the banks and the IT sector remain to be seen to be beneficiaries. The broad consumption story will take some more time to come through. Probably after June, July next year is the better time to look at these stories.
Sandeep, just to sort of confirm, you said another 10% downside from these levels. So basically around 21,500 levels in the next 3 to 6 months. That's what your view is.
Yes, it depends on how the US behaves and how the US market moves. It's contingent on whether we see strong dollar appreciation come through. It's also contingent to see what kind of policy initiatives vis-a-vis the rest of the world that the Trump administration unveils. So there could be some potential disruption to the assumptions which the world has on growth. And if that happens, there's definitely downside there. Valuations, as we have been saying for some time, are definitely challenging and demanding. And all that will contribute to a market correction.
Okay, all right, Sandeep, thanks a lot for joining in. Sounding a little bit cautious on markets. There could be pockets of opportunity, but not ruling out a 10% correction from these levels as well. Thanks a lot, Sandeep. Wishing you a good day ahead. Well, let's get